I'm Mark McClurg with Real Estate Mortgage Network, as Chris said, and thank you very much for inviting me again. I don't see any faces that I saw at the last presentation we gave last month, but maybe I'm missing a couple. But anyway, it's a pleasure being here. Thank you, Shirley. Thank you, Sharon. Thank you, Chris. Thank you, Eileen, for allowing me to step in. The purpose of our presentation today is to talk about really what it takes to enter into the mortgage market these days. It's a whole lot different than it was 5-6 years ago. Back then there wasn't a whole lot of verification of anything, and that's kind of what got us into some trouble here recently. And you've probably all seen the news. You don't need to explain what's going on in the housing markets and what's going on in the mortgage markets over the years. But the purpose of this seminar is to kind of bring you up to speed on what the new rules are, okay? And they're really not new rules. I started in this business back in 1991, and the rules are basically what they were back then, versus what they were 5-6 years ago. So there's several important things we need to consider when trying to get into a mortgage situation, and the first and foremost is probably credit. Okay, that's where a lot of people seem to stumble. Okay. They don't understand the credit game. Credit scores came into place. They don't understand credit scores, how to manipulate that score to increase their ability to purchase a home or purchase a car or even advance in their job, quite honestly, because it affects all aspects of your life. Secondly is the income and employment stability. Now you're all working for the city and county of Denver, so you're all pretty stable as far as that's concerned. I would hope anyway. And then
today.
And then funds to close. How much money does it take to close on a home loan? Where's that money going to come from? And sorry about that. Where's that money going to come from? Various resources that can be tapped into to help as far as down payment assistance and those types of things. We're going to go through a little bit of that today. Reserves, what you have left over after you spend your money on the funds to close. Okay. That's become, especially in conventional lending, reserves are pretty important. They want to see that you're not spending your last nickel getting into the house and then not having anything to support it or maintain it in the initial years of the mortgage. And then collateral, the home you select. Okay, no mortgage company wants to finance a property that's going to fall down. Okay, they want, that's the collateral for the loan. They want sufficient collateral to be able to support the loan that they're giving. So first of all, credit and credit scores. Credit scores came into play, well, they've been in play for a long time, but in the mortgage business, really in the last 10 years, they've become very, very prominent, okay, as far as those are concerned. It used to be 680 was the grade score. Now, in order to qualify for the best rates that are quoted with Wells Fargo or US Bank or my company or any other company out there, in order to qualify for the best rates and terms, you need a 740 credit score to be able to put 25% down. That's not reality, quite honestly. Okay, so credit scores have become a big player. Now the credit scoring system was created by Fair Isaac, and consequently the name FICO. Okay, that's Fair Isaac Company, and Experian uses their raw Fair Isaac scoring model. Okay. TransUnion and Equifax use derivatives of that, either the classic or the beacon score, but they're all based on the FICO model. FICO expansion scores have really not been widely used in our industry as of yet. It used to be that we could do a lot of manual underwriting types of things to where we could evaluate rent history, we could evaluate rent-to-own situations, we could evaluate utility payments, cell phone bills, things of that sort to be able to qualify you for a mortgage. Nowadays, credit scores is nearly mandatory. With very few exceptions, you have to have some sort of credit score. What's excluded from the score? Anything that is discriminatory is excluded. Your occupation, your salary, your employer, your history of employment, where you live, interest rates on the accounts that you have. So if you're paying 25% on a credit card, that's not held against you. We're going to try to advise you to get into something a little different, but it's not held against you from the credit scoring situation. How is your score used by others? Well, obviously for mortgages, car loans, and credit cards, you have to have some sort of a score. Okay, in order to qualify for the zero down payment with Toyota or Honda or anything like that, you need to have a 700 or better credit score to be able to utilize. Mortgages, obviously, I just told you 680 used to be the barometer. Then it moved up to 700, then to 720, and now it's even 740 for the best rates and terms. Credit cards. We've all gotten those 0% interest credit cards in the mail or credit card applications in the mail. Again, credit scores determine your eligibility for those types of things. Your rent. You go to a landlord, you go to an apartment complex or something, they're likely going to do background checks and credit history. Your employment. It can be the separator between you getting that advancement in your employment or not. Okay, if there's two qualified employees and they do a background check or credit checks, the one with the better credit and better background is going to get that job if equally qualified. And insurance. We have an insurance person right back here, and quite honestly, credit scores enter into the insurance market as well. I think they use an insurance score versus a credit score or something, but it's still based on the same scoring model. So credit scoring and you know, in my black and white thing, it didn't come out very well. So I printed the color one there, and it still didn't come out very well. I need to change the color scheme, but anyway, this kind of tells you what's in that credit scoring model. Now, a lot of people think that they make their payments on time, they got great credit. Well, that is true, okay, from that standpoint, but it only represents 35% of the total model, okay, not even half, okay. Another 30% of the credit scoring model is the amounts that you owe. Okay, now this doesn't go into mortgages and installment loans necessarily, but what they're talking about is revolving lines of credit. If you've got a $1,000 credit limit and you're always bouncing up against $1,000 as your balance, then it's going to affect your credit score negatively. Okay, I counsel people all the time to go out, you know, because that's the fastest way to improve your score is through a revolving account. A lot of people are adverse to credit cards. But I encourage people to go out and get a credit card, whether it is a secured credit card with Wells Fargo or the local credit union, or whether it's from Capital One or whatever, it doesn't make any difference, okay? It's how you use that credit card that makes the difference, okay? The ideal is that you keep your balances at less than 30% of your available credit at all times, okay? The reason I say that is because most of the credit card companies will report to the credit bureau when the statement is issued. Okay, very few people go in and pay their balances or pay anything on their balances prior to getting that statement. Okay, so when the statement is issued, that's when they report to the credit bureau. It costs money to report to the credit bureau, so they generally do it once a month. There are some companies, however, that do have an algorithm, okay, that they determine or they predict when your balance is the highest through the month, and that's when they report. Okay. So you always want to try to keep that balance at 30% or less of your available credit. That is individually as well as cumulatively. Okay, so if you've got 3 credit cards, okay, 2 of them are down below the 30%, but one of them is a hit above that, it'll affect your score negatively. Okay, the lower that balance is, less than 30%, the more advancement you'll get as far as the score. But 30% is really where you need to strive to be. So if you've got a $1,000 credit card, never let the balance exceed $300. The 15% is the length of credit history. Okay. Now somebody that's in their 50s or 60s may have credit history from back when they were 20 and have 30 years or 40 years worth of credit history. Okay. Those folks are the ones that are going to, if they manage their credit properly, the way the scoring model wants you to, okay, those are the folks that are going to have the 800 credit scores. Credit scores range 350 up to 850. The higher they are, the better. Okay. Folks that are just entering into the credit game, never really had a credit card or never had a car loan or anything like that, and are just getting established that length of credit history, will put a ceiling on your credit score. You're not going to get to that 800 level, but it's very possible to get to those 700 numbers in a very short period of time. The new credit, okay, now like I said earlier, I counsel a lot of people to enter into the credit game with a credit card or whatever, okay, only because they don't have any credit profile, so they have to build a credit profile, and that's the easiest way to do it, okay, quite honestly. Because if you don't have any credit, you have to have a cosigner on a car, you have to have a cosigner on a house. You got to do a lot of things cosigner-wise. Where a credit card, you can go in and deposit $300 with Wells Fargo or a local credit union, and they'll give you a secured card for the equal amount, today, okay, regardless of your credit history, past credit history. So new credit does affect your score, but it's only 10% of the score. Okay, what we're really looking at is that 65% that we need to work with there, your credit history and the amounts that you owe. So new credit affects you. Okay, inquiries affect you. Okay, I've seen clients, okay, go to the mall during Christmas and sign up for everybody's 15% discount, okay, for their credit cards, and watch their credit score drop 100 points overnight. Okay, so don't do that. Okay, you don't want everybody looking at your credit profile. For one thing, it puts you out there for the identity theft situations as well. So you want to control, okay, that, but you still need to play the game. Okay. And then the types of credit you have will have a 10% impact as well. Mortgages and installment loans through major companies like a Wells or a credit union or whatever, those are considered to be the best, okay, as far as types of credit. Okay, credit cards then fall in there after that, okay, which are Visa, MasterCard, American Express, or Discover are the four majors. Will give you the best, okay, results in your score. Then you get into the department store cards like Macy's or Kohl's or whatever the case may be. That's the next tier. Okay, and then the next tier down from that is the finance companies. Somebody like Springleaf or Household Credit or someplace like that will typically lend credit under to clients under more adverse circumstances. Okay, those are the types of companies that people go to when they can't get credit otherwise. Okay. So that is the lowest tier, so you're going to want to try to stay away from that or get into a position, if you're not already in a position, get into a position of qualifying for more standard financing options. How many of you have looked at your credit report in the last year? Oh, wow, good, okay. Well, if you haven't, okay, there's a site that's located called annualcreditreport.com that is it's a site that was created by Experian and Equifax and TransUnion, because the government came in, the Fair Credit Reporting Act came in and told them they had to give people access to the credit for free. So at one time a year you can go in and access all three credit reports. Okay, if you haven't accessed your credit recently, I would certainly recommend you do so. Okay, through the annualcreditreport.com site. Now, they're not going to give you a score without a charge. Okay, they give you the credit report for free, but you're not going to get a score without a charge. Okay, and I think it's like $7 a file or something like that, or $7 per bureau to get the score. I'm gonna even suggest that you don't bother. Okay, I can tell, and most other mortgage professionals can tell. Based on the history showing on the credit report, they can give you within 30 points what your score is. Okay, from a mortgage standpoint. And also, the score that you're going to get from the annualcreditreport.com is what they call the consumer score. Now, a lot of people think there's only one credit score. There's not. Okay, first of all, you got 3 bureaus, so right there's 3. Okay, then you have different tiers. Okay, the insurance company is going to pull your credit for an insurance score. The auto company is going to pull their credit for an auto score. The mortgage company is going to pull credit for their mortgage score. Okay, and the employer and various other people or rental agencies and things like that are going to pull a different score. So there's really 12 different scores when you look at 3 bureaus and 4 layers. Okay, the reason for that is because they add layers of risk to the raw score. The score that you're going to get from annualcreditreport.com is the raw score. Okay, and then there's layers of risk. Okay, based on the type of financing that you're qualifying for, that are going to have an impact on that score. Sometimes it'll be 30, 40 points. Okay, between the score that you get from them and the score that I would pull for a mortgage. Okay, and I've seen it go both ways. Okay, I actually had a client come in, thought they had a 618 credit score, which really didn't qualify for much of anything as far as mortgage was concerned at that point. But then when I pulled the score, it was 642, and they qualified for pretty much anything they wanted to do. So but I've seen it go the other way as well. So I'm going to tell you, the scores that you're going to get from annualcreditreport.com are simply a barometer. Okay, it's not a score that we would use. It's not a score that an auto company is going to use, or anybody else that's pulling your credit. Okay, it's hard to get where you're going if you don't know where you are. Okay, so that's why I recommend that you access the credit profile on annualcreditreport.com, or I can pull credit, or whatever you choose to do. But when you pull it through annualcreditreport.com, it doesn't have an impact on your score at all. Okay, and you get the raw data. Okay, from that raw data, okay, I would recommend that you talk to a professional, myself or others, okay, that are in the business, that understand credit, and they can tell you pretty much what needs to be done in order to get your score to a point to where you're going to qualify for a mortgage or a car or whatever. Okay, so know where you are and get started today. Okay, it's important. It's probably the most important 3-digit score you're going to have. You know, you got a 9-digit score for a Social Security number. That's an important number as well, but the credit score is probably number 2. Okay. Do's and don'ts. Okay, when you're getting ready to apply for a mortgage. A lot of people. I don't expect anybody to understand our business. Okay. I don't really understand a lot of other people's businesses, and there's a lot of things in our business that really logic really doesn't play a part. Okay, so we just gotta deal with it, quite honestly. Okay, first of all, optimize your credit. Okay, review your credit report with a professional. Pay down your credit card balances. Address any negative items right away. Okay, if there's a medical collection on there, or a parking ticket that you failed to pay, or whatever the case may be, take care of that small stuff immediately. Okay, budget for your new housing payment. Okay, when you talk to a professional, they're going to tell you what you qualify for. Okay, now your qualifications may be different from what you're comfortable with, and we'll get to that in a minute. But figure out what type of price range you're going to be in and what your monthly payment's going to be on that mortgage. Okay, and then budget for it. Okay, if you're currently paying $900 in rent and you're expecting a $1,200 house payment, okay, which is common in my business, that extra $300 should be going into savings every month. Okay, so you're preparing. You're actually making the payment on a monthly basis already before you even start. Establish an emergency fund for unexpected expenses. Worst thing you can do is walk into a house and not have a dime to your name. Okay, you're going to have things are going to happen. You're going to want to make some changes. Okay, no existing house anyway is perfect. Okay, there's going to be things that are going to need to be done. You're going to need moving expenses. You're going to need, a variety of things when you get into a new house. Do not spend your last nickel getting in and do not have anything in reserve. Okay, so I always recommend you establish an emergency fund. If you talk to Dave Ramsey, which is a financial guru on the radio, okay, $1,000, okay, get it started immediately. $1,000 can come. You can have a garage sale and get $1,000, okay. So get that together, okay, and set that aside. That's not to be used by the house, okay, that's to be used for unexpected expenses after you move in. Determine the source of the down payment. Determine the source of the down payment needs and your qualifications. That, in talking with a professional, you'll understand what you qualify for. They'll take into consideration, if they do the right thing, they'll take into consideration what your expectations are and what you're willing to write that check for every month, okay, versus what they qualify you to do. Talk to a professional early and develop a plan for action, okay. Even if you're getting ready, even if you don't think you're going to be buying a house for a year, okay, start now, talk to a professional, and put a plan together to get there in a year.
Also with that though, when you're talking about a house payment, you have to consider insurance and you have to consider your taxes, don't you?
Yeah, we're going to get to that in just a second.
So that's an additional amount with that house payment, isn't it?
Yeah.
Okay.
Generally, house payments these days generally include taxes and insurance for the most part, okay? There are some people out there that do like to do it themselves, okay, and manage it themselves, okay? If you put less than 20% down, you're required to have an escrow account included in your mortgage payment.
Okay.
So that eliminates some of that. And we take into consideration not just the principal and interest on the loan, but any mortgage insurance or hazard insurance or taxes in that equation as well for qualification purposes. Don't change career paths. Okay? Don't open any new credit accounts unless it's part of an optimization strategy, okay? Don't deposit funds that aren't related to your employment or your regular source of income, okay, in your bank accounts, okay? And that's what we get stuck on a lot, okay? Somebody will get, you know, a check from mom, okay? And they'll put it in the bank, and then all of a sudden we're gonna have to ask, well, where'd that money come from, okay? Well, we may or may not be able to create the documentation. If mom was kind enough to write you a check, maybe we can, okay? But if it was cash money, it can't be used for the process, okay? So it's automatically deducted from your available funds, okay? Some people have a side business, okay? Maybe they have a business out of home or something, and they're depositing, you know, checks in, or having a garage sale. I mentioned that a little bit ago. Okay, those funds, you know, unless we can adequately document the source of those funds, they're not available to be used for the purchase of a home. So what I recommend you do, if you have those sources of income, is to go cash the check, use that cash for your everyday living expenses, and allow your employment income to accumulate in your checking and savings accounts. Okay. Don't allow any bills to linger. I just had last week. Okay, I've been working with this gal almost a year. Okay, getting her credit situation, you know, straightened around and everything. You know, we pulled credit last week, and she's got 3 new collections that showed up last month. Okay, simply because she got this $20 bill for a medical copay or something and disregarded it. Okay, well, the medical collection industry is they're ruthless. Okay, some after 30 days, if you don't pay the doctor within 30 days, it goes to collection. They don't waste any time anymore, okay? So any type of billing that you get or any type of notice that you get from anybody, take action on it now, okay, versus letting it linger and affecting your credit down the road, okay?
Can I ask you a question?
Yes.
You say not to open any new credit, but what if you have open credit that's with the 0 balance?
Do not close it either, okay? Keep it at 0 balance, okay, which is fine, okay? You don't want accounts to close because that affects your length of credit history, which is 15% of the score, okay? So don't close any accounts, okay? You know, once they're open, okay? If it's a major credit card, like a MasterCard or Visa, that you don't want to lose access to, because some companies will discontinue the card if you don't use it, okay? So if it's a MasterCard or Visa that you don't want to use access to, go out and buy a tank of gas with it once a month, okay? Or every 3 months even, okay? Just show some activity, but then pay it off at the end of the month with what you would normally pay in cash, okay? So department store cards and things like that, you know, it's up to you whether you want to use them or not. I mean, it'll still affect your length of credit history, but that's a lower tier as far as the credit hierarchy is concerned, so it has less impact than what a major would. Down payment requirements. Do we have any veterans in here? All right. Thank you for your service, sir. Veterans qualify for no down payment. Okay, that's part of the VA benefit. Highly recommend you take advantage of that. Okay, if you've got that availability, highly recommend you take advantage of it. It's absolutely the best loan program out there. You know, for a first-time home buyer or somebody that's limited on funds. Okay, certain rural areas. If you purchase out in Windsor, you know, not Metro Denver. You can't do it in Metro Denver. But in rural areas, okay, there is a no down payment option there. It's called the RD loan, rural development loan. Okay.
You can go out and buy a farm?
You can't be a working farm.
Okay.
Yeah, generally it has to be limited to 5 acres. So it's limited. Okay. I do have some farm loans though available. I mean, if you want to buy a farm, we can talk. Okay. But that doesn't fit in the rural development program. These are for single-family homes, okay, in rural communities. Okay. FHA loans, probably the next best after the 2 0 down payments. The FHA loan is 3.5% of the sales price as your down payment responsibility. All kinds of the down payment assistance programs utilize the FHA program. So very few of them will participate with conventional lending, but for FHA loans, the down payment assistance work real well. Fannie Mae's home path properties, there are certain, and there's a slide in here that give you access to, or to give you access to all the websites that you can find the bank-owned properties. Fannie Mae is one of the governing agencies that regulates home mortgages for the government, and you've probably heard a lot about them. They're about bankrupt. They're owned by the government now. But anyway, they've got properties for sale, okay, that they technically own, okay, and they're under the Home Path program. Home Path is a conventional loan. No appraisal required, 3% down payment, no mortgage insurance. Interest rate's a little higher, but no mortgage insurance. So it's really a good option, okay, if you can qualify for that program. Generally, a 660 score and better is required to qualify for the Home Path properties. And they just eliminate a lot of the guidelines. And they will pay up to 6% of the sales price towards your closing costs. Now, they can't participate in the down payment, but they can pay the closing costs. Conventional loans, okay, which Fannie Mae is one of the conventional regulatory agencies. Freddie Mac is the other one. You've probably heard that name as well. Those are conventional loans, okay, and generally they require 5% down. There are some 3% down programs available in certain areas called My Community that may work out for somewhat or some folks. And then they also allow for the My Community program also allows for the second mortgages, okay, up to 105% to cover closing costs and things like that too. So we can certainly talk about that. The qualifications are pretty stiff.
Can I ask you a question?
Mm-hmm.
Do you have to be qualified for FHA?
Do you have to be qualified? Not under any, there's no guidelines other than just your employment, your credit, and things like that. You know, FHA is...
income?
Nope.
No?
Nope.
Okay.
No, you can do an FHA loan up to $406,250. Okay, there's no income limitation. You're required to live in the house for, they say, 1 year. Okay, but there's no other restrictions.
And what's the difference between FHA and conventional?
Well, FHA is administered by Housing and Urban Development. It's a federal housing agency and administered by the Housing and Urban Development. And they've just got.
You have to be a first-time buyer, right?
No, you don't.
No? Oh,
No.
okay.
Nope, I've done multiple FHAs for second, third, fourth-time buyers.
So if you already have an FHA, can you get
cannot
another?
do a second one.
Cannot do a second.
And the conventional, like when they're asking, like, are you applying for FHA or are you applying for this? Like, for me, it's Chinese language. I don't
What was that?
You know, some applications, they're asking, like, are you applying for FHA loan or are you applying for conventional? Like, I don't know the difference between two.
Okay, I'm going to talk about that in just a second,
Cool.
the differences between the two of them. So,
Okay.
so you have hopefully you'll have a better understanding. If you don't, please feel free to ask me questions.
Okay.
Okay. Now, you mentioned if you have an FHA already, can you get the second one? You can't have two simultaneously. If you sell your house that has an FHA loan and buy another house with an FHA, you can do that. Okay, but you can't have two simultaneously. Unless that, well, there are some loopholes there, okay? Like if you had an FHA loan in Florida and you wanted to buy a home here because you no longer live in Florida, distance, you know, commuting distance to your work, things like that. There are some exceptions to that, but generally, no, you can't have to. Okay. Down payment sources, obviously your personal savings, okay? And this is where it comes into play where, you know, if you got a $900 rent payment, you're expecting to go into a $1,200 house payment, well, save that extra $300, okay? Save that money, okay? Gift funds from family members. A lot of moms, dads, brothers, sisters, aunts, and uncles are more than willing to assist in the purchase of your first home, okay? If that's an available resource for you, that's great as well. Retirement accounts, okay? Not a huge advocate of this, but a lot of people do it, okay? Hardship withdrawal on a retirement account, and you have to check with your administrator to see if these things are available. But a hardship withdrawal can normally be used for a down payment on a first home, okay, without any penalty. Now, you will pay the interest, or you will pay the taxes, but you're not going to have a penalty associated with the withdrawal. The ideal way, if you're going to use retirement accounts, is to borrow against it, okay? And I don't know about the city. You're going to have to talk to the city and county about what your processes are. But with a 401k at a secular employer, okay, you can generally borrow up to half of what you've got in there. So if you've got $15,000 in there, you can generally borrow $7,500. Okay. You pay payments back to your 401k, but the interest that you pay back is coming to yourself because it's your money, okay? So that's the ideal way of doing it. There is no penalty and no taxes paid when you borrow. Sale of assets, okay? You've got a 1965 Mustang sitting in the garage. You can sell that Mustang to me. and use that money, okay, to purchase a home, okay, or sale of anything really. You know, the only thing about it is we do have to verify the value, okay, and we have to verify the sale of the asset, okay. So with a check, a bill of sale, and then some sort of appraisal. With a car, it's easy because we just go to Kelley Blue Book or Edmunds or something, and it shows us what the value of the item is, of the car is, except for some exotics. But for the most part, we can get a value, and then we just kind of track the bill of sale and transfer title. Okay. Borrow against an asset. If you've got that '65 Mustang and the local credit union will lend you 10 grand on it, that's fine too. Okay. So you're borrowing against an asset to be able to. It's technically not allowed to borrow money to put down on a home, but if you're borrowing money against another asset for the down payment on a home, it makes it allowable. Okay, so because it's secured by something tangible. And then various down payment assistance programs are available. We'll get into those briefly here too. So down payment assistance, like I said, there's several programs available. A lot of them have local administration. Adams County has a program, includes the City of Westminster. Douglas County has a program. City of Aurora has a program. Colorado Housing Assistance Corporation, acronym CHAC, C-H-A-C, okay, administers the program for the City and County of Denver. Jefferson County, with the exclusion of Arvada and Westminster. Now, I don't know why Arvada is in there, but the City of Westminster is covered under Adams County's program. So, and then the Colorado Housing and Finance Agency, which is CHAFA. They're located on 20th and Lake. They have an excellent program that we utilize regularly. The downside to CHAFA, I guess, is their interest rate's a little higher than what you can get on the open market because they dictate what their rates are. They're only allowed, or they will only lend you 3% of the first mortgage amount, so it's not going to cover everything. We still have to get the seller to participate as far as closing costs and things like that, when you're dealing with CHAFA. But it's still a great program and is available statewide no matter where you're at.
What makes it great, though?
What makes it great? Their income limits are significantly higher than what CHAC's is, and I'll get to that in just a second here, on a slide or two down. Their income limits are much higher, okay? They're local, okay? You make your payments right to them, okay? They're local, and that's pretty much it, actually. But the income limits are what we run into the most. We'll get to that here in just a second. DPA qualifications, you do have to be a first-time home buyer. You can't have owned a home in the last 3 years. That's the definition of a first-time home buyer, somebody that hasn't owned a home in the last 3 years. Income limitations. With most of the programs, excluding CHAFA, you're limited to 80% of the median income based on your family size, okay? I'll get to that slide here in just a minute to give you those numbers. You must attend a home buyer education class, okay? They're designated by their program specific, okay? For instance, CHAFA has an online thing that you can do for their program, but all the other programs won't accept the online. You have to do it in person and things like that. Ideally, they want you to do the home buyer education prior to you putting an offer in on a home, okay? Because their home buyer education not only talks about the mortgage process and your expectations as a homeowner, but also goes through the home purchase process as well, what your realtor does for you, what the home inspection's all about, all the various aspects of the home purchase they go through. So ideally, you want to go through that program prior to putting an offer in on a home. Minimum borrower contribution is 1% of the sales price. Okay, so if you buy a $120,000 house, you're going to need $1,200 invested in the transaction. Okay, all the rest of the funds can be dealt with the down payment assistance. Some require additional property inspections and repairs. The city of Aurora, for instance, has a lead-based paint evaluation, and I ran into a termite inspection that I had to have out there. Funny part about it, there was termites. I didn't think there was termites in Colorado, but there were in Aurora. So they have some additional inspections you have to do. CHAC requires you to have a lead-based paint evaluation. Okay, so those inspections are required by the various down payment assistance groups. Here's the income restrictions based on that 80% of the median income. Okay, if you're a single person, you can't make you can make up to $44,450 and qualify for the program. As your family size increases with a husband or children or grandma, grandpa, whatever, if they're dependents of yours, then you can increase the limitations there. And as you can see, 6 persons and above, $73,650, and this is all household income, not just you, but everybody in your household who over the age of 18 has to go into that calculation. So if mom and dad are living with you and they receive Social Security, even though they're not on the loan, their income still has to be considered as a disqualifier.
Mark, this is for the local down payment assistance programs, and as you know, CHAFA
Yeah.
has higher limits. Are you
Yep.
going to be getting into that?
I'm going to get into that in
Okay.
just a second.
Okay.
Yep, CHAFAs are higher. So those are for the City of Denver, the Adams County program, City of Aurora, Douglas County program. All those is what those income limitations are for. Okay. The requirements must continue to be owner occupied. Okay, you can't turn it into a rental property a year down the road and expect the down payment assistance not to come due. Okay, it does establish a second mortgage. Okay, now all the programs are a little bit different, have a little different caveats to them. So some are interest bearing and require monthly payments. Okay, some are forgivable over time. The Adams County program, for instance, is $7,000. It's a grant, basically. Okay, they put a second mortgage on your house, but over 5 years, that $7,000 goes away. Okay, so you no longer owe it, and there's no payments on it. Some have no payments, but are paid off at maturity, like the City of Aurora. Okay, they'll lend you up to $10,000. Okay, for down payment and closing costs. They don't require payments. There's no interest that accrues, but the bill's still out there. So when you sell that house, okay, you've got a $10,000 obligation to the City of Aurora that you're going to have to pay. Okay, and then all household income is considered. Colorado Housing Finance Agency, CHAFA, okay, does have higher income limits, okay, 71,000, I believe, and I didn't print that slide. I should have printed it from the other one, but I didn't. I think it's 71,000 for a 1 or 2 person household, okay, to qualify for their main program. And they have another program that's not limited to first-time home buyers, and we use a lot for people that make over 71,000. It goes all the way up to 91,000. And if you have a family of 3 to 4, it'll go to 98,000. An income that you can still use their program to be able to qualify for down payment assistance. It's available statewide. Okay, like I said, they do have a program that's not limited to first-time home buyers. It's called the Home Opener Plus. Down payment is limited to 3% of the first mortgage amount. So if you're financing $120,000, they'll give you $3,600 towards your down payment requirements and closing cost requirements. But that's all. Okay, and that generally won't cover everything. Okay, and won't cover everything. So we have to get the seller to participate as far as closing costs and prepaid expenses and things. Okay, they have unlimited funding. Okay, they're not getting their money from the federal government like a lot of these other programs do. So they create their own bonds and they sell their own bonds and they generate their own funding. So they, virtually unlimited. And liberal qualification guidelines. They're very 620 credit score. Okay, is what they require. And they're just a little bit more lenient as far as certain underwriting guidelines are concerned. Budget for the house payment. Determine your qualifications with a professional. Your qualifications in your comfort zone may be different. Okay, I may tell you that you qualify for a $300,000 house, but you're not willing to make that $1,800 payment. You tell me then, okay, what you're comfortable with, and we'll back that out, okay? We have that go the other way as well. Maybe husband's got bad credit and can't be on the home loan, okay? However, he's got an income of $60,000. Well, we can't use his income, but we can't use his credit, okay? So you qualify based on your own income, okay? Knowing, okay, that you've got this $60,000 that's not able to be counted, okay? So you may very well be able to afford that $1,800 payment, or whatever the case may be. Consider any added expenses, okay? When you're a renter, a lot of times some utilities are included in your rent. You don't have to worry about insurance. You don't have to worry about trash removal, you know, things of that sort. Those are added expenses when you own a home, okay? So we have to consider those items as well, you know, when you're purchasing a home. Actually, Senator Bennett from here in Colorado has legislation pending in the Senate right now called the SAFE Act, S-A-F-E, and they want mortgage companies, okay, or the regulators who impact the mortgage companies, to take the utility costs of operation of a home, okay, into consideration in the qualification guidelines, okay. It can be as much as 25% of your house payment, okay. You know, I've seen electric bills $400 or $500, you know, or electric gas bills $400 or $500. So, you know, I'm all about that, quite honestly, okay. Taking the utilities into consideration will get a lot less people in trouble, okay. Make the payment by saving the difference, and we talked about that. If you're making $900 rent, $1,200 house payment, save that extra $300 and make the payment in your mind every month through the savings plan. Consider the total price of home ownership. The house payment generally is referred to PITI, which stands for property taxes, or property insurance tax, what am I talking about? Principal, interest, taxes, and insurance, okay? That's what we're going to qualify you on, is the principal, interest, taxes, and insurance, okay? And any mortgage insurance that's included, okay? Utilities, your gas and electric, your water and sewer, your trash removal, cable TV and internet service, all those things you should consider in your budget, okay, as far as what you think you can handle on a monthly basis. Maintenance of the home, okay. There's some pundits out there that want you to save 10% of your house payment every month, in addition to making your house payment, save 10% every month into an account for the maintenance of the property, okay. And consider a home warranty. Okay, I can't stress that enough. Home warranties are available on every home purchase, whether you buy it or whether the seller pays for it. It's a valuable thing, in my opinion. Okay, they run about $350, $400 to get a home warranty, but it protects all the major systems, all the appliances in the home, and for the first year, you don't want to run into a furnace that goes bad or a hot water tank or whatever the case may be. So that home warranty is valuable. It can be negotiated right into your purchase agreement, have the seller pay for it if you choose, if you can get it negotiated that way, or buy it yourself. Very good systems. Purchase a home for the right reasons. Okay, so many people purchase homes for the investment opportunity in homes. I'm not saying that homes aren't an investment, they certainly are, okay, but they're a long-term investment. It's not something that you're going to get rich quick doing real estate, okay? The average person. Donald Trump does, okay? But he's got millions of dollars to play with. We don't, okay? We're dealing with, you know, coming up with $1,200 for the down payment, okay? So it's not an investment. It is an investment, but it's an investment over time. So much of what got us in trouble in the early 2000s and the latter part of 2000s is people were treating their house as an ATM card. And they'd go out, they'd refinance the home and take cash out to pay off credit cards or to buy the boat or to buy the second car or a college education, wherever the case may be. And then all of a sudden the housing market crashes and they're upside down. Well, that's not the good thing, okay? You need to plan for those other things and do things that way and not use the house as an ATM card, okay? You build community, okay, by buying a house, okay? Family safety and security, okay? You know, maybe it's a healthy environment to have a family in an apartment that's 3 stories high and doesn't have any place to play or anything like that, I don't know. But when you own a house, you have your own spot, okay? You can deal with what you want. Fixed payment confidence. Rental rates, I just read an article that came out May 1st in the Denver Business Journal. Here in the city and county of Denver, the highest rent increases since 2001, 6.3%. Okay, that's good. Rents are on a continual rise, okay? People that have lost their homes are now in the rental market. Vacancy rates are down under 4%, okay? Historic lows, okay, quite honestly. Okay, rents are way up, okay, and continuing to rise. You can pretty much expect about a 4% increase in rental rates on an annual basis versus a house. You get a fixed payment. Yeah, maybe you have an adjustment for property taxes or insurance or something, but generally it's a fixed payment. You know what you're going to be spending every month and for the next 30 years. Okay, express your lifestyle. Okay, in an apartment you can't make any changes. Okay, in a rental house you can't make any changes. If you want, paisley walls or whatever the case may be, you're free to do that in your own home. Okay, you're free to have a garden in the backyard. You're free to have a swing set. You're free to do the things that you want to do that you're not able to do in the rental property. It's yours over time. Okay, it is an investment because every payment you make, you're gaining equity in that property. Okay, after 30 years, it seems like an awfully long time. Okay, my parents lived in the same house for 30 years. I know that's not the norm these days. Okay. My parents lived in the house for 30 years, and that was basically their retirement. There was no pensions or, 401ks and things like that back when they were around. Okay, that was their retirement. They had a paid off house. Okay, and a home is an investment, but it's a long-term investment, and it does appreciate over time. Now, we've gone through a rough time here the last 5-6 years. Okay, with property values declining, but if you look over the last 20 years, you've still seen if somebody purchased a house 20 years ago and are selling it today, they still realized a gain in equity, okay? Generally, 15 to 20% here in Denver, okay? Mortgage products, to answer your question, okay? Mortgage products, the FHA, VA, and RD loans, okay? RD stands for Rural Development. They're government-insured loans, okay? The government is actually ensuring that you are going to make the payments, okay? If you fail to make the payments, the government comes in and makes the bank whole on that, okay? There are much more liberal qualification guidelines for FHA, VA, and rural development loans, okay? And no or low down payment options. And again, the down payment assistance programs that we've already talked about coincide very seamlessly with the FHA, VA, and RD loans, okay? So that's the main difference, okay, between the FHA and conventional, okay? Conventional, now let me go into the FHA renovation loan because it happens to be one of my favorites, okay? The FHA renovation loans, okay, if you're buying an existing home, is it going to be exactly the way you want it? Absolutely not, okay? The average homeowner in the first 3 years of ownership is going to spend between $8,000 and $10,000 in renovations to that property to make that property theirs, okay? To make it their lifestyle, okay? So the FHA renovation loans are very, very key right now, okay? Simply because, especially with all the bank-owned properties, when people lose a home, they don't necessarily take the best care of it, okay? So there's damages that have been done. Maybe they've taken some things that didn't really belong to them that were supposed to go with the house. I've seen them with the copper stripped. I've seen them with the cabinets ripped out, dishwasher, hot water tanks, furnaces, air conditioners, all those things gone, okay? Bank's not going to finance it in the condition that it's in, okay? The insurance company's not going to insure it in the condition it's in, okay? That's where the renovation loan comes into play. How's the bank going to sell that? They're going to sell it to somebody who qualifies for a renovation loan, where you can purchase the house as is, okay? Have a renovation bid from a licensed contractor that's going to bring that house up to FHA standards, and they do have minimum property standards, okay? Have it bring it up to their standards, and then include any extras that you want to do, okay? Like if you want, you don't want Formica countertops, you want granite countertops, well, okay, we can do that. Or you want to, put a second bathroom in, or remodel whatever. Okay, we include all that into one mortgage. So you make one mortgage payment. Go ahead.
Is there a cap to that?
$406,250 for a single family home. So you buy a house for $100,000, $150,000. Okay, put $50,000 into it. You're picking the house because of its location. Everything in real estate is based on location. Okay, it's not the house, it's the location. Okay, so you pick a house based on a location. Maybe you're buying the ugliest house on the block. Okay, well, it doesn't have to be an ugly house forever. Okay, because you can buy that ugly house, turn it into what you want it to be, and actually gain equity in a lot of cases. I've had situations where people have had 20, 25%, 30% equity. Okay, I did one up in Broomfield. They bought it for $325,000, but almost $150,000 into it. Okay, through a renovation loan. The house was worth. We had it reappraised because we refinanced it under conventional form financing after it was done. Appraised at $750,000. Okay, so the guy's got, you know, $475,000 into it. Okay, but they're priced at $750,000. So things can be done. You can gain a lot of equity and things like that with the right purchase. Okay, and the right renovations. Okay. So finance the purchase or renovation, make the expected major repairs right away. Okay, let's say you walk into a home and it's got a 20-year-old furnace. Okay, well, that furnace is going to go bad at some point. It's going to go bad tomorrow, maybe not. It's going to go bad a year from now, maybe not. It's going to go bad 5 years from now, maybe not. Okay, but if it does, okay, you're going to have to come up with that $3,000 out of pocket to be able to pay for that furnace. Okay, or take advantage of the renovation loan and do it now. Okay, and take care of those major expenses right away.
Would then the new home warranty cover the renovation?
No, new home warranty. Well, new home warranty covers the implements that you put into the renovation.
Right.
You know what I'm saying?
Right.
Okay. They're not going to pay for the furnace.
No,
okay?
but they would cover what would be in
Right. Yeah. Yeah. They do. It's brand new. I mean, what's their loss? You know, it's better to warranty that than it is to warranty a 30-year-old furnace. So.
Are those interest rates comparable between FHA against renovation loan? FHA?
About 1/4% higher than renovation loans. Very nominal. It's one point. Okay, 1 point. A discount point is 1% of your mortgage amount. Okay, and the difference between a regular FHA and an FHA 203K renovation loan is 1 discount point. You can either pay that in cash or pay it as part of the down payment assistance or whatever. Okay, or you can increase the interest rate 1/4% to offset that point. Okay, and not have the extra upfront fee that you pay over time. Okay. 1/4 point difference. Did I answer most of your questions on the FHA anyway?
Yeah.
Okay, very good. Conventional loans, okay, generally you're going to have a little lower monthly payment. Okay, the reason for that is, well, I'm running out of time. Reason for that is because you're typically putting more money down, okay, and the mortgage insurance is a little less, okay, on a conventional loan. However, their qualifications are stricter, okay. Generally higher down payment requirements, okay. Most conventional loans require you to put at least 5% down. Now, there are some programs out there at 3% down, okay, but generally speaking, 5% down. They have stricter qualification guidelines. Okay, if you put less than 20% down on a conventional loan, you are going to pay what they call private mortgage insurance. Okay, and with the mortgage insurance increases that FHA's had over the last year and a half, the private mortgage insurance is actually less expensive now. Okay, which is okay. Okay, but then they also have what they call risk-based pricing. Okay, like I told you, in order to qualify for the best rates that are posted at the local bank, okay, you need a 740 credit score of 25% down buying a single-family home. Okay, anything less than that, there's going to be some variation as far as that rate's concerned. Credit score goes into the situation. How much you're putting down goes into the situation. You know, various risk factors that will affect that rate or cost one way or the other. Okay. So there's a lot more options with conventional loans. If you get to 90% loan to value, if you can put 10% down on a home loan, there's a lot of variation. You can do first and second mortgages and all kinds of different things. They've got various interim adjustable rate loans, a lot more variations than what FHA has. 1, 2, 3, 5, 7, 10-year interim adjustable rate loan. There's just a lot of variation there. Okay, but generally the difference between the reason somebody would go FHA versus going conventional is because they can't meet the guideline requirements, okay, for a conventional loan, or they need down payment assistance, or they need the lower down payment versus 5% versus 3.5%, something on that order. Okay, that's the reason FHA is so popular. FHA right now is financing almost 60% of the mortgages nationwide. Okay, because of the guidelines. Items needed for mortgage approval. The standard items, okay, W-2s and tax returns for the last 2 years, 30 days worth of paycheck stubs, most recent 2 months bank statements, quarterly or 2 monthly statements for other investment accounts like 401k or something like that. And then other items are specific to the borrower, okay? If you've got rental properties, or you've been divorced and you're receiving child support or paying child support, then divorce decrees or bankruptcy papers, or various things are going to be individually specific, okay? But those first five items are definites for all lenders, okay? Anything that's multiple page, like a tax return or a bank statement, you're going to have to provide all pages, okay? Even if the back page is blank, you still have to provide it, okay? Because the first page will say 1 of 5, and the back page being blank will say 5 of 5, and we have to have all 5, okay? Rent versus own, okay? I was going to go into a big elaborate explanation about why it's beneficial to own versus rent. Didn't feel I had time, and I don't. Fixed payments and versus rising rents, okay? First and foremost, okay, like I said, rentals are going to continue to increase. Building is at an all-time low, okay? They're not building nearly as much as the population is growing, so rents are going to increase versus payments on a mortgage are fixed. Interest rates and taxes may be tax deductible, okay? And I say may, they always are, but if it's beneficial, you talk to your income tax preparer as far as that's concerned. I'm not a tax accountant, okay? You build equity over time. It's an appreciable asset, okay? Over the last 5 or 6 years, we've seen some depreciation. I understand that, but all in all, a house is an appreciable asset. Family safety and security, express your lifestyle, build community, and as a homeowner, quite honestly, politically, you're more important, okay? And your voice is louder, okay? You got choices.